I model for that directionally, and so it's one of those things you know it's not like if Russia reduces their dollar reserves by this amount, then it adds say 1% to inflation. It's not that specific, but it helps kind of tie things together in terms of the direction that things are going. And so one thing I do is I separate a dollar bear market from a change in the dollar reserve status. And so, for example, if you look back over the past 50 years, we've had three dollar bull cycles, kind of $2.50 bear cycles, depending on where we are in this current one. And so, each one of those, the dollar didn't lose reserve status. It just had these big giant fluctuations compared to other currencies. And so a lot of times when the dollar starts to go down, you have all these headlines about dollar reserve status being questioned. And so one thing I try to do is I separate, you can have a 40% dollar bear market versus other currencies without the dollar reserve status being changed. So one is I say, okay, that's one thing, that's a separate variable. And then two, then we can look at longer term structural stuff and say separate from that, or somewhat tied to that, but still somewhat separate to that dollar bull bear cycle, is there something more structurally happening under the surface? And so my view is yes. I mean, basically, the creation of the euro in about over 20 years ago now, that has somewhat reduced the dollar's importance, in terms of its share of global reserves. And then now the next round that we're seeing is that Russia is more interested in selling their oil in euros and then de-dollarizing their reserves. They've been investing primarily in gold and euro-based assets for their reserves. We also see, for example, between Russia and China, they've actually de-dollarized their trade quite a bit, and it's partially local currencies, but it's also the euro took a big chunk of their trade between Russia and China. And we've even seen, for example, Russia and India have a little bit de-dollarized some of their trade as well, which is interesting because India is a closer ally to the United States. And so we see this kind of playing out where we see more and more direction of a global, kind of a multipolar currency system, rather than the dollar having such a strong lock on global trade. And so overall, I do think that factors into my longer term dollar bearish thesis. And I think it's almost inevitable to happen, because one thing I like to point out is that in the beginning of this, the petrodollar system, so the monetary structure that we've been in since the 70s, at the beginning of that system, the U.S. GDP was like 35% or more of global GDP, and we were by far the biggest commodity importer. And so they had all these deals where almost all commodities are priced in dollars, regardless of who's buying, who's selling. It's all dollar based. But when you get to the point over time where the United States is something like 20% of global GDP, a little bit more, a little bit less, depending on if you're looking at purchasing power parity or nominal. But it's gone down in any way you measure it. And then you look at the fact that we're no longer even the biggest commodity importer anymore. We're number two. Basically, the world's just kind of shifting more and more towards having a handful of currencies that are able to buy commodities rather than just one currency. And so I do think that factors into basically a dollar bear market thesis in an overall more inflationary environment.
I had not thought of this until you said that just now, but it occurs to me, if you have multiple currencies competing for market share in commodities, or just commodities priced in multiple currencies, that's actually a good thing for price discovery, isn't it? I mean, to what I don't know to what degree you subscribe to various manipulation theories and so on, but to whatever degree U.S.-based interests are exerting undue influence over prices in these few nexuses that we have in the West, diversification out of that seems like it would have to be good for price discovery.
Well, yeah, I mean, the argument there, and sorry if you hear like a leaf blower, like I hear they're doing the lawn care outside, so sorry if there's any sort of interference. But basically, if you look at how pricing works in markets, it's often that marginal price that generally comes in and affects the whole thing. And so when we think of, for example, stock price going down, it's often a very small percentage of the shares that are actually trading hands rapidly, and the majority of shares are just sitting there. And yet those that small percentage moving around quickly can affect the broad price pretty significantly. It affects all the price of the shares, even the ones that are not moving. And so the same thing can happen in commodity markets. And so generally, when you have a dollar bear market, and if you were to have an environment where more currencies can price commodities like say euros or China's currency, that opens up, it basically broadens the types of channels that can go around in terms of how these pricing are set. China's even been they experimented first a couple years ago with using different blockchain type stuff to be able to buy commodities. So they did tests with some of the big iron producers, for example, in order to be able to buy commodities outside of the dollar-based system. And then, of course, more recently, they moved increasingly towards their own central bank digital currency. And so basically what they're trying to do is be able to buy commodities in their own currency, so that you don't have a situation where the largest commodity importer is using another country's currency in order to buy all of their commodities. And so I do think over time that should be positive, for the price of many commodities, and kind of opens up some more demand out there.
Okie doke. But one more last macro question, because I want to get to specific commodities and get your take on some things, other assets. Try to rip through those quickly. But will good news ever be good news again for markets? Or when will bad news actually be bad enough that markets won't go up on bad news? We have this, or another way of asking this is there any way for the U.S. economy to ever not be a Fed-driven economy? How do we get out of this mess? Is that possible?
Well, if you look again at the concept of the long-term debt cycle, usually this sort of, when there's this much debt in the system, when there's this many bottlenecks in the system, usually it requires a very big phase change, which is generally, at the core of that is a currency devaluation before things essentially get reset. Because when they build up that much debt, when they use artificially low interest rates, they use all sorts of programs to basically get debt this high to begin with. They never could have gotten this high without some of the manipulations that have occurred. So when they get debt this high, it's almost impossible to unravel it without crashing the economy. And so instead, they turn more towards currency devaluation, which is what we've seen in 2020 and 2021, for example. And so essentially, until you have probably a significant currency devaluation and kind of a somewhat of a reset of the situation, you're unlikely to untether markets from these big kind of central forces. And so that's actually one of the big challenges. And so, but if you look at individual segments of the market, there are still areas that are kind of undergoing price discovery a little bit more. And so, for example, if you look at value stocks or some of the commodity stocks, they were more sensitive to good news and bad news in the way that would make sense. And so, when you had kind of, say, vaccine announcements or any sort of positive news on the virus front or positive news on fiscal stimulus or things like that, some of those more value-oriented things did better. Whereas growth, because growth stocks kind of became like a bond proxy, there are these big expensive equities that kind of, they're somewhat detached from the cyclical gyrations of the economy, and so people pile those into those when they want to feel safe. And so a lot of times those do actually pretty well in a more kind of problematic environment. And so we've had these kind of growth to value rotations. So I would say that if you look at the market underneath the surface of the index, it kind of made more sense in that, in the sense that where the cyclical things have responded to good economic news more. And so, but I think that for the broad indices to start following good news, it's going to be very tough until we actually get past some of these giant debt problems that we have, and that's not going to be, smooth.
So is that a Lyn Alden forecast? There is a reset coming?
So I think, a reset can take multiple shapes. And so, I think one of the models that I use again the most is the 1940s, because you had an environment where, you had huge inflationary spikes, and unlike the 70s, they still held interest rates at zero. And because that, the difference between the 70s and the 40s was that in the 70s, you actually had pretty low private and federal debt as a percentage of GDP. And so you had policymakers able to raise rates to try to quell inflation. Whereas in the 1940s, you had federal debt as a percentage of GDP over 100%. And so, when they were having these big fiscal expenditures for the war, when you had inflation going up to, year-over-year terms, it got as high as like 19 to 20% at some points. Even though the average for the decade was something like 6%, you had these big spikes in inflation. And the Federal Reserve just said, no, we're just going to hold rates zero. We're going to support the war effort. We're even going to cap long end yields if needed. And so I kind of viewing that environment as that's one way where you can devalue something over time. And so if you look back at that 30s and 40s period, you had kind of the one-time reset with the gold revaluation in the 30s, but that wasn't the end of it. That was kind of the first stage of it. And then the later part of it was the 40s, where you had just inflation running hot, interest rates held at zero. And so whether you were holding the short end of the curve or the long end of the curve or the treasury market or many other types of debt instruments, you were losing out on an inflation-adjusted basis. And so that's kind of my base case, is that, however this works out, I expect that, most types of fixed income instruments are likely to yield below the prevailing inflation rate for the better part of this decade. And then if you could punctuate that with more, harsh kind of stepwise changes, but that'd be kind of my at least minimum case.